What is going on with the bond market? The Federal Reserve is in the process of cutting interest rates, but the long end of the yield curve continues to trend higher. Why is that? First, the Federal Reserve typically targets the front end of the yield curve, very short-term interest rates. They could, if they wanted to, target long end of the yield curve. They did that certainly during COVID. So right now what we're seeing is short-term interest rates are moving lower in response to the Federal Reserve's moves. But the long end of the curve, the 10-year, the 20-year, and the 30-year, those interest rates continue to move higher despite the fact that the Federal Reserve is cutting rates. What does that tell us? The market believes that first, we've probably averted a recession, and because of that, the Federal Reserve doesn't have to cut any more. Beyond that, there will be more inflation. The policies coming out of Washington, D.C., there's going to be a tremendous amount of debt. Investors also believe that lending money to the government based on policy and all of the rhetoric that we've got going on, the shifts and everything, would enable them to get more interest because it's a more risky investment giving money to the federal government based on current policies. Given that, when you take a look at the long end of the yield curve, interest rates continue higher, and that will affect mortgage rates and other interest rates that we would pay here as consumers because of the long-term viability of the federal government.